Welcome back, you legends. I'm Dr. Cat, and let's get straight into this quick market update into the FOMC data release later today. Yesterday, the markets closed slightly in the red with the exception of the Russell 2000, which closed deep in the red. Dow Jones, NASDAQ, S&P, Russell, all in the red yesterday. This is the stock market map. You see a mishmash of green and red everywhere. Energy especially got hit pretty hard, and then we had semiconductors giving back a lot of the gains from earlier in the week and last week. We had a clear defensive sector rotation, healthcare, consumer defensives leading the market with utilities, and then we had cyclicals, financials, and technology lagging. In a bullish, optimistic market, typically you'd see technology, financials, and consumer cyclicals leading the pack. Yesterday, we had the opposite. We're already seeing that defensive late cycle rotation out of the market leaders and into the defensives as the market gets ready for a turbulent and risky couple of weeks. What's the big deal? FOMC minutes. Basically, we're going to get an idea of what the Fed discussed at the last meeting. Quite often, FOMC minute release days are slow until 2 p.m. when we get that quick reactive move, and then Thursday we get typically the opposite of what happens Wednesday. So if we get a rally in reaction to FOMC, historically speaking, that would signal a market top, and then we get a big sharp reversal the second day. This is the beginning of Jackson Hole. Typically, Jackson Hole is a bearish event that includes 2023. Even during that 2023 monster bull run, it was also bearish 2022 on both occasions, producing a huge bearish engulfing candle, very negative day. The difference was 2023 we had a bounce back up, and 2022 completely failed and produced a very negative month. So today is going to be the beginning of the Jackson Hole Symposium. Thursday, we're going to get more Jackson Hole stuff and initial jobless claims. Friday, we're going to get the Fed Chair Powell's speech as part of that Jackson Hole Symposium. So let's go right into that historical outlook based on what happened both times last year and the year before. So last year, Jackson Hole was this ugly bearish engulfing candle right here, August the 24th. Difference was the market was actually bottoming. We had that rally, double bottom here with the second low, forming a higher low and a bullish hammer candle. And we had a rally all the way to this resistance line. 2022 was completely different. The market had already topped. Then we had the Jackson Hole ugly, incredibly bearish move to the downside, and we continued to sell off for a couple more months before the market bottomed in mid-October. Notice both times we had that huge bearish engulfing candle. So what's the setup today? The setup is different. The setup is completely different. So in 2023, we had the market form that local bottom and then rally. This year, the bottom already formed. We're a couple of weeks into this rally, and we're closer to the top than we are to the bottom. In 2022, the market had already topped. So we're not like 2022, not like 2023. The market hasn't topped yet. It is getting closer to a top. So let's break it down. This is the S&P 500 1-hour chart, and it is indicating that the market is topping very, very soon. Very likely just days away from a top. Now I'm going to discuss in detail why that's the case. Before that, please take a screenshot of this if you need it. The thicker red lines at the top and the bottom, these are the 2 sigma expected moves. The regular expected moves are these thinner lines in the middle. The expected move for today to the upside is 562 and to the downside is 555. The 2 sigma move to the upside is 565. That means we revisit the all-time highs. The 2 sigma move to the downside is 551.9. Okay, so how does the setup actually look heading into the FOMC minutes? What does the chart say in terms of what happens next? Well, the chart is screaming, absolutely screaming, a top is coming. Why? Look at the RSI. Typically, the market will not top until the RSI produces what is called a bearish divergence. That means the market continues to hammer slightly higher highs as the RSI actually forms lower highs. This has happened every single time the market tops throughout the last couple of months. Every single time. Slightly higher highs, lower highs on the RSI. The final high produces the top, and then we get the breakdown. The final high gives us the top, and then we get the breakdown. Final high gives us the top, and then we get the breakdown. The final high has not been made yet. The market has formed the first high. We need to see consecutive higher highs as this bearish divergence continues to form. Very likely that happens over the next couple of days, including today on the FOMC minutes. That means a rally in reaction to the FOMC today or tomorrow is very likely a bull trap as the market puts in that final high, grabs that last bit of liquidity, usually from retail traders, dumps on retail traders, and then exits the market and begins that aggressive deleveraging and de-risking event. Now let's take a look at the NASDAQ, and we do have that exact same look, right? We typically don't top until we form that bearish divergence, multiple higher highs on the daily and hourly charts. Then we get this bearish divergence on the RSI forming lower and lower highs. That typically means every successive push higher is being accompanied by less and less conviction. That's what the RSI typically indicates in this case. Each successive push higher is accompanied by lower momentum, less conviction, and more sell-side activity from the big money, the smart money. This is where retail traders go kind of nuts, right? The FOMO rally, fear of missing out, they begin to go extra hard. They see this huge move up. A lot of them miss the bottom. They miss this entire move up, and they have this fear of missing out. I don't want to miss on this next big move. And then they begin to go aggressive at the worst possible time, because that's when big money dumps on retail traders. Big money sells, retail buys, and that culminates in this aggressive top and sell off. We had again that exact same look. Look at this gap up, rip to the upside, absolute crazy looking short squeeze. Then a double top with a significant bearish divergence on the RSI, calls the top, and then we get the sell-off. The market does not recover for another week. So we get that prolonged period of weakness and consolidation for more than a week. Again, the final top here comes in as the market hammers in slightly higher highs, each consecutive high corresponding with a lower high on the RSI. Classic bearish divergence, rising, bearish rising wedge structure, breaks down, calls the top, and we get an aggressive sell-off. We're now in the middle, not the end of this bearish divergence. We're still in the middle. We still need to see one higher high from the NASDAQ 100 and the S&P 500. That likely happens within the next couple of days. That high is not to be bought. It is to be sold, to take profit, to exit, de-risk, tighten your stop losses, all of that stuff. It's not to go crazy here. It is not the time to go crazy, long, aggressive, and buy. That was the time back here. We already bought. We rode all the way to the upside. And here at Money Time Machine, we've already started to rotate. We exited all of those classic NASDAQ and tech long positions. We're out of those trades completely. We're out of those trades, and we're now rotating as part of this late stage cycle. There's a very specific playbook to follow. If you're part of the trading community, you know exactly what I'm talking about. I discussed this in detail over the last couple of weeks. There's a very specific kind of rotation that happens here in the FOMO stage, and then another rotation as we move to the downside. We're now in the FOMO stage rotation. A very specific set of stocks tend to outperform the market in this stage as the market tops, and then a different set of stocks tend to outperform as the market begins to sell off. By the way, if you appreciate this content, slap that like button right in the face. And if you want to support the channel and get access to all of my technical analysis notes and trades, check out the Money Time Machine trading community on Patreon. Now let's take a look at the VIX. What is the VIX doing? The VIX has already bottomed and it's rallying. Typically, the market will not top until the VIX puts in a bottom first and begins a divergence. What kind of divergence? Look at this. Market puts in successive higher highs. And as the market is doing that, the VIX is actually forming higher lows. The VIX is moving higher even though the market is rallying. This is a huge red flag. The VIX and the S&P are inversely correlated. When the market is rallying, the VIX is moving down. When the VIX is moving to the upside, the market is selling off. It's a very basic and classic inverse correlation. When the market is selling off, fear rises. That's why you see a breakout in the VIX. Pretty much the same thing here. Whenever we get a sell-off in the market, the VIX moves to the upside. So what does it mean when the VIX actually moves to the upside when the market is still rallying? It means that the market is actually turning bearish underneath. And the market, big money, big players in the market are hedging. That's what it means. It means the market participants, especially big money, is rotating out of call positions and buying put positions as a hedge. It is anticipating a huge breakout in volatility and a correction sell-off in the market. So what has been happening in the last few days? Well, another red flag. The market is still moving to the upside. It is slowing down, yes, but it's still moving to the upside inch by inch. And while that's happening, the VIX is also rallying. So again, we're now seeing that hedging activity. Timing is everything. And based on that bearish divergence on the RSI, on both the S&P and the NASDAQ, that tells us that top very likely hasn't been made just yet. We're getting very close, extremely close, probably 48 hours, 24 hours away from that key market top. And as that top forms, you'll see the VIX continue to move higher, even as the market forms that final higher high and that final bearish divergence. Let's zoom in and take a closer look at the VIX. The VIX is up top, S&P 500 down below. We had this bullish falling wedge on the VIX and we got the breakout. The VIX has already broken out. Exact same kind of thing happened as the market was actually topping. And here, let me show you what I mean. Here it is, bullish falling wedge on the VIX, and then the VIX got that breakout, and then it moved sideways again for several days, and then we had this triple top, quadruple top on the S&P as the VIX was forming these higher lows. This final top in the S&P corresponded with a significantly higher low in the VIX as compared to the prior lows. That was the final warning to get out, the final chance to get out. After that, we had a huge breakout in the VIX and a massive sell-off in the market. We are in this stage. We're somewhere in this stage. We formed the first high. We're now waiting for a bunch of consecutive higher highs, potentially over the next couple of days, as the market completes that final topping formation on both the NASDAQ. NASDAQ very likely will fail to make a new high. The S&P 500, on the other hand, is likely going to match or potentially exceed the prior high, and that will be the final top for August, and then we get a second wave of the sell-off into September, October. We're not quite done here. Take a look at the XLY relative to XLP. This is the risk on risk off ratio chart, the bull to bear, basically rotational chart. XLY still outperforming XLP. We're still not at the top. I'm still expecting one final hurrah move for consumer discretionary stocks before we top and before the market tops. After that happens, after we get that move higher and fill this gap, that'll be the perfect time to take a look at rotating out of classic bullish sectors and into classic defensive sectors. That is consumer staples, utilities, healthcare, all of those sectors as the market begins to pare back all of these gains from the last couple of weeks. These other sectors will likely continue to rally, but not the S&P, not the NASDAQ, as that defensive rotation begins to take place. Up top is the smart money indicator. High yield bonds down below is the S&P. High yield bonds have already made a new high. The S&P hasn't yet. Usually high yield bonds will lead the market to the upside and to the downside both. Take a look at this example. Double top with a lower high, double top with a higher high. Bearish divergence called the top in the market, and then we got the sell-off. Again, high yield bonds began to make these higher lows, even though as the market was forming these lower lows, called the bottom, got the rally. So high yield bond smart money still indicating we move slightly higher for the market, form a higher high or an equal high on the S&P. NASDAQ 100 very likely fails to do that, and that will establish another huge bearish divergence where the S&P forms that higher high and the NASDAQ fails, kind of like what happened in late 2021. If we take a look at late 2021, this is the S&P 500 up top in here. It topped in January. If I add the NASDAQ 100, you'll see it topped much earlier in late November. Here it is. This is the final top in the NASDAQ. We had this huge bearish divergence between the two, and that corresponded with the final top in the market, right? S&P went on to make a higher high. NASDAQ failed. Why does that happen? Well, it's because tech stocks tend to top earlier, and then when that happens, you see rotation out of tech as the market becomes more bearish and into defensive sectors, healthcare, consumer defensive, utilities. These sectors are heavier in weights in the S&P. That's why you see the S&P make that higher high and the NASDAQ fail to do the same. That's because of that late stage defensive rotation. That's the same kind of rotation that I'm talking about that's going to begin very soon here as the market puts in that market top. Be very clear, I'm not calling for a cycle top that is the final top in the market. I don't see that happening this month. I think that happens much later in the year, potentially January. Again, I'm still expecting kind of the same timing pattern here where the NASDAQ tops sometime later this year and then the S&P tops sometime very early next year, and that gives us the final top. The kind of top that I'm discussing today is the top that forms before that bearish seasonality kicks in September and in October. I'm talking about this kind of top, right? This kind of top that forms sometime before that bearish September, October seasonality. If we take a look at election year seasonality, we typically top in the middle of August, about the 20th of August. So again, very close to where we are now. Typically around the 20th, 21st of August, we get that August top, pull back, and then we get that second move higher in September, and then we get that sell-off. That is the typical election year. In the open field election year, with it, which is this year. This year is an open field election year, meaning there's no sitting president running. We get a much more bearish September. So keep that in mind. We could very well be forming that final top for this pre-bearish September-October seasonality. And in that case means September, October, both very negative. I'm not quite sure that's the case because we get a rate cut in September. Usually when we get a rate cut, we get a couple of weeks of a very strong rally after the rate cut, and then the market tops. So there's a lot of factors to consider here. There's bearish seasonality, there are rate cuts, and then there are other things to consider, like if we get much weaker than expected unemployment data in the interim, and if we start to see a very weak bank earnings, banks begin to report much earlier than the rest of the market. So there's a lot of factors to consider, but we'll cross that bridge when we get there. We're not quite there yet. So again, multiple bearish divergence on both the S&P and the NASDAQ. S&P likely matches or exceeds the prior high. NASDAQ will fail to do so. Next couple of days are going to be critical as the market puts in that final low in this multiple bearish divergence pattern. Not quite there yet, but we're getting very close. It's time to begin rotating out of risk on sectors and into these late cycle FOMO trades. It is time to tighten risk parameters and approach this kind of market structure with objectivity and care. Obviously, we don't want to lose all of these gains that we've made since the bottom. That's why we have to be very careful now. That's all I have for you today, legends. Thank you so much for watching, and we'll catch you in the next one. Bye-bye.
Oh, wow.